Welcome to the deep dive. Today we're cutting through the noise of BMO Financial Group's Q3 2025 earnings, and we're asking a crucial question, really. Are these impressive numbers a sign of sustainable strategic growth? Or are they maybe just a well-executed maneuver in what's still a pretty uncertain economic environment? We've got the full earnings call transcript right here, and the investor presentation slides from August 26, 2025. We're going to use these to uncover how BMO is really navigating these complex waters, from their big headline numbers down to the nitty-gritty details of their loan book and their tech investments.
It's definitely a critical question, and these earnings calls, they're rarely just about the immediate bottom line, are they? They offer this unique, almost, forensic look into how the major financial institutions like BMO are performing, yes, but also how they're actively adapting. So what we're looking for today isn't just what they reported, it's more about why these particular results matter, how they connect to, broader market trends, and what they might signal for the future, perhaps even impacting your own financial decisions down the line.
Okay, so let's unpack this then, keeping that central question in mind. BMO's CEO, Darrell White, he kicked off their Q3 2025 call with some pretty eye-catching numbers. What's the headline story here for their financial performance, and what does it really tell us about where they stand in the market right now?
What's genuinely fascinating here is the sheer consistency, the positive momentum. BMO announced their second highest quarter on record. Now, that's not just a big number. It really signals a remarkable turnaround, I think, and maybe a validation of their recent strategic shifts. Their earnings per share, EPS, as you often hear it called, was up a significant 22% year over year, hit $3.23. Net income, $2.4 billion, and pre-provision pre-tax earnings, or PTPT, saw a 13% jump to $4 billion. And that PPPT figure, it's key because it strips out the impact of credit losses. So it gives us a clearer view of BMO's underlying operational profitability, before they factor in economic uncertainties. So these results, they don't just show growth, they show broad underlying strength. Right across every operating group, it indicates the bank's core engine is really firing on all cylinders.
Second highest quarter on record? Yeah, that definitely stands out. But they're not just celebrating that, right? They seem laser focused on something they're calling an ROE rebuild. For our listeners, maybe just quickly, what exactly is return on equity, ROEs, and why is it so central to BMO's long-term strategy, especially right now?
Right, that's an important question because ROE, it's really the efficiency metric that investors watch most closely. It's basically how much profit a company generates for every dollar of shareholder capital put in. Now, BMO has a stated medium-term target. It's 15% for the bank overall and 12% for U.S. personal and commercial specifically. This quarter, they improved their overall ROE to 12%, and it's 11.1% year to date. This isn't just some arbitrary number they've picked. Their push towards 15% is a critical signal. It tells the market that their current capital allocation is hopefully on track to deliver strong returns, especially as they integrate recent acquisitions and, navigate these higher interest rates. And to get there, they're executing on 4 key initiatives: improving U.S. P&C performance, normalizing provisions for credit losses, we'll probably talk more about that, optimizing overall operating performance, and enhancing capital efficiency. So you can see how these pillars aren't just operational tweaks. They're more like foundational shifts, really aimed at fundamentally improving their profitability.
Okay, so on that note of navigating, what did BMO's leadership actually say about the economic backdrop? Are they seeing clear skies ahead, or is there still, significant turbulence they're preparing for? And how does that tension kind of play into their strategy?
Well, they certainly acknowledge an uncertain economic environment. We hear that phrase a lot, don't we? But BMO provides a bit more nuance, I think. They note some trade-related risks, particularly for the North American economy, seem to have eased somewhat, even if the final outcome isn't entirely clear yet. Canada, they observe, is navigating a period of, let's say, modest growth. But crucially, the U.S. economy keeps showing resilience. You've got strong corporate earnings, a robust labor market, continued consumer spending. BMO seems to believe these factors should support growth into 2026. So there's this balanced view. It highlights their cautious optimism. They're not ignoring the clouds, definitely not. But they see significant pockets of sunshine that allow them to, pursue their growth agenda.
Right. It sounds like they're not just reacting to the market then, but actively trying to reshape their own structure to capitalize on these conditions. We're seeing mentions of significant organizational changes, particularly in U.S. banking and even in acquisition. How are these strategic moves unfolding, and how do they feed into the ROEB build we were just discussing?
Absolutely. They've made these strategic organizational shifts precisely to accelerate performance and drive those ROE improvements. It seems quite deliberate. For example, they've brought together U.S. personal and business banking, commercial, and wealth management all under one leader, Aaron Levine. The stated goal here is to drive greater synergies and provide what they're calling superior one client service.
One client service?
Yeah, basically making it easier for clients to access everything BMO offers, which in theory leads to deeper relationships, more revenue per client. Makes sense. And then on the acquisition front, they announced they're acquiring Burgundy Asset Management Ltd. Now, this isn't just about bulking up assets. It looks like a strategic move designed to really expand their wealth management and financial planning capabilities.
Especially for high net worth clients. That's a segment that typically generates higher margins, right?
Okay.
So these are clear signals, I think, of focused growth in key high-value areas, directly linked to that ROE push.
That gives a strong picture for their overall strategy. But let's zoom in a bit on their individual business segments, starting with Canadian Personal and Business Banking P&C. What's happening on the ground there? What kind of customer engagement are they actually seeing?
In Canada, yeah, they're reporting strong, high-quality customer growth. That seemed to be a key message. Their checking account growth, for instance, is apparently almost double the industry benchmark.
Double. Wow. Yeah, which suggests their acquisition and retention strategies are working quite well up there. And a great example of their product innovation is this savings amplifier account. It seems to have really resonated. It's now surpassed $12 billion in deposits. They pulled in another $2 billion just since the last quarter.
Incredible.
That kind of growth, it suggests they're effectively meeting a real market need right now. They also launched something called the BMO Preferred Program for investors. That attracted $1.4 billion in mutual fund flows, apparently by deepening relationships. So it isn't just about getting new accounts. It's about moving clients beyond single products, making them full-service customers. And that's a significant driver of sustainable revenue, obviously.
That savings amplifier growth is really impressive, and it points to, like you said, a keen understanding of current customer needs. But as BMO actively works on that ROE rebuild, a big part of that strategy hinges on their U.S. performance, right? So what does the data reveal about U.S. personal and commercial banking, especially given how competitive it is south of the border?
Yeah, the U.S. P&C segment, it shows continued momentum in that pre-provision, pre-tax earnings growth. And importantly, with strong positive operating leverage.
Meaning revenues growing faster than costs.
Exactly. Which is always a healthy sign for efficiency. They're seeing good client acquisition in both their Midwest markets and the newer West markets from the Bank of the West integration. Crucially, they mentioned deploying enhanced digital tools for faster loan decisioning, deeper client insights, particularly in their emerging middle markets business. Now, that's a high-return segment for them. So these digital enhancements mean they're not just competing on price anymore, but maybe more on speed and tailored service.
And they got some awards, too, I noticed.
That's right, some external validation. World Finance Magazine named them Best Commercial Bank in both Canada and the U.S., and also Best Private Bank in Canada for the 15th year running.
15th year.
Yeah, so those kinds of accolades, they definitely underscore their service and capabilities, especially in such a fiercely competitive environment like the U.S.
Okay, so while retail banking forms the bedrock, I know a lot of listeners are often really keen on those high-impact areas, like wealth management and capital markets. What insights do we have into BMO's performance there this quarter, and how are these divisions contributing to the overall strategic picture?
Well, BMO Wealth Management had a very strong quarter. Record revenue, actually, driven by continued growth in net new assets, plus those strategic investments they've been making in talent and innovative products. And the recent Burgundy Asset Management acquisition, that's clearly going to bolster these capabilities further. It adds significant depth to their high net worth offerings. Then in BMO Capital Markets, that PPT figure we talked about has been consistently strong this year. They're benefiting from robust underwriting and advisory fees. Seems like they're capturing more mandates, executing on pipelines that have been building up. Trading revenue was also robust, which shows they can adapt quickly to, changing market conditions. And this diversification of revenue streams across these different segments, it's a key strength for the bank. It insulates them somewhat from volatility in any single area and definitely contributes to that overall ROE goal we keep coming back to.
Right. It all ties together. Now, in a world that's increasingly shaped by technology, how is BMO leveraging digital and AI capabilities? Are these investments actually driving tangible value? Are they moving the needle for customer experience or efficiency?
They seem to be, yes. They're absolutely moving the needle, or at least that's the message they're pushing. BMO says they're deploying digital and AI capabilities right across the board and seeing tangible value in areas like decision-making, enhancing customer experience, speeding up software development, even improving employee productivity. For instance, they specifically launched Lumi Assistant. It's an AI-powered tool. It equips their frontline teams with real-time, simplified access to critical policy and process info.
So helping the staff help the customers faster.
Exactly. It's not just some back-office efficiency thing. It's about enabling their staff to provide better, faster, more informed advice and guidance to clients. And this quarter, they also received that prestigious 2025 Sullent Model Bank Award. For payments innovation, actually. For 5 separate digital payments and client experience initiatives.
5 separate ones.
Yeah. So this isn't just talk, right? It looked like a clear, ongoing investment in future efficiency and really fundamentally enhancing the client experience through tech.
That is impressive innovation. Points to future-proofing their operations. Okay, now let's talk about the less glamorous, maybe, but equally critical side. Credit quality and risk management. With all this talk of economic uncertainty lingering, how are their provisions for credit losses the PCL's looking? And what does that tell us about their forward-looking caution?
Right, the risk side. Well, the sources indicate that total provisions for credit losses, PCL, were actually lower this quarter. $797 million. That's compared to last year. PCL on impaired loans moderated to 45 basis points.
Okay, so 0.45%. What does that mean in simple terms?
It means for the loans already showing signs of trouble. They set aside a bit less this quarter compared to maybe the peak worry period last year. It suggests a slight easing of immediate credit concerns. However, and this is a critical signal, I think that the provision for performing loans, the ones that look okay right now, saw a $24 million build.
So they're putting more aside for loans that aren't currently bad.
Precisely. Their chief risk officer directly attributed this build to continued uncertainty. Things like trade policies, fiscal policy developments, maybe unemployment trends in Canada. So this tells us BMO is still proactively reserving for potential future headwinds. They're not assuming clear sailing ahead, which demonstrates, a prudent forward-looking caution. It's also worth noting they did mention losses were higher in Canadian unsecured retail portfolios like credit cards and lines of credit, and gross impaired loans also increased in Canadian commercial banking. So those are clearly areas they are actively monitoring.
So they're definitely being proactive, adjusting the sails for potential storms, as it were. What about the health and diversification of their broader loan portfolios? Where are the strengths and where are they exercising particular caution in their lending overall?
Yeah, if we connect this to the bigger picture, diversification is key for them. Their loan portfolio is broadly diversified by product type, by industry, by geography. That inherently spreads the risk. For business and government loans, for example, 56% are in the U.S., 44% in Canada and other regions. Pretty balanced. Their commercial real estate portfolio, CRE, which gets a lot of attention these days, it's 11% of their total loans. They stressed it's well managed, with a significant chunk, 45%, being investment grade.
And the office part of that's often the worry.
Right. The office portfolio, which is 10% of the CRE portfolio, so about 1% of total loans, is also diversified, they say. Then you look at Canadian residential secured lending mortgages, essentially. That's a huge portfolio, $213.1 billion.
Yeah.
But 89% is secured, and the average FICO score remains quite strong at 790. Even though there was a slight uptick in 90-day delinquency rates, they also highlighted that about 26% of their mortgages are renewing in the next 12 months.
That's a lot coming up for renewal with higher rates.
It is. But they pointed out the average FICO score for that renewing group is even higher, 797. And the uninsured loan-to-value, or LTV, is only 49%.
Meaning borrowers have a lot of equity.
Exactly. These are strong indicators of borrower quality. It suggests that while rising rates are definitely a factor, the underlying financial health of these specific borrowers seems pretty robust.
Okay, so pulling it all together, what does this mean for our central cloaker? Sustainable growth versus just a tactical maneuver. We've seen BMO navigate this uncertain economic environment with, frankly, strong Q3 results, driven by those strategic organizational shifts, targeted acquisitions like Burgundy, significant investment in digital and AI, and very careful forward-looking risk management, it seems. They're clearly focused on rebuilding their return on equity. It really demonstrates a robust and forward-looking approach, which suggests, to me at least, that their current momentum seems built on pretty solid strategic foundations, not just a short-term fix.
I think that's a fair assessment. To recap for everyone listening, you've really gained insight into how a major financial institution like BMO meticulously tracks and plans its performance. We've gone from those high-level financial metrics like EPS and ROE, right down to the granular details about specific loan portfolios and their tech adoption strategies. In this deep dive, I think it reveals that BMO isn't just reacting to the market conditions. They appear to be strategically shaping their future through disciplined execution and pretty clear foresight. even with these persistent global uncertainties hanging around.
So for you, our listeners, maybe consider this as we wrap up. How might BMO's focus on that one client service idea and their ongoing digital transformation impact your own banking experience, or even just the competitive landscape in the financial sector in the coming years? What might these strategic moves mean for the future of personalized banking and financial advice, especially in an increasingly digital world? Something to think about. We definitely encourage you to keep observing how these big players continue to adapt and evolve. Until next time, stay curious, stay informed, and keep diving deep.